First of all, I was thinking if silver were trading $16 instead of 21, 22, this might actually be a telethon. And you'd be like Jerry Lewis. I'm dating myself, but you get my point. You'd be raising money to keep silver from going to zero. All right, so backwardation. Okay, normally it's a hard word to use, but let's just say that when there's we're talking about silver here, right? So I'll just talk about silver. When there's plenty of above ground silver available to make delivery on demand, you just have to find it and sort it out, and it's immediately available. The future spreads in the financial markets, which are derived off of the spot market, go into a gentle upwardly sloping curve from front to back. So when there's plenty of silver around, or plenty of, word to use, the market is in contango, right? So it's the spot market is here and everything is anchored off of that. Yeah, like that. It's anchored off of that. And there's your difference between 1 month and next is financial, right? It's entirely about the cost of money and getting your silver a month from now. You want to buy silver today, it's $21. You want to buy silver tomorrow, it's $21.10 because we have to store it, et cetera, et cetera. When you have a commodity that's in true short squeeze like silver has been in the past, you get full backwardation. And full backwardation is that curve inverted. And so the front month or the spot market, true backwardation, the spot market leads. And we're going to get into what's going on right now, and Bob will add to that as well. But this is the background. The back month, the front month, the spot market determines. That's the dog, right? So if spot goes to $25, and not only does it go to $25, but people are unwilling to defer their purchases for a month or 2 months or 3 months. What ends up happening is the market inverts, and it's, I want my silver now. Think of it as food that needs to be eaten or oil that needs to be used. And for whatever reason, there's no availability of silver right now for delivery. Now, those usually are temporary in silver. They could be miner on strike, historically, miners on strike, a hiccup on the delivery process, COVID, refiners shut down, who knows? There's all kinds of things that do that. But what it means, whatever the cause, what it means is that I want my silver now, not a month from now. Now, the phenomena that we saw over the last, I'd say 3 months, and seems to be persisting depending on where the market is a third scenario. And the third scenario is really a transition from contango to backwardation. And that is where the physical market, the spot market, the one that we all buy, is trading at a premium to futures. So that's backwardated. I want my metal now. I want my metal now, not tomorrow. But the rest of the futures are not reflecting that demand. And so if you're a little bit paranoid, you don't have to be a lot paranoid anymore, just a little bit paranoid, that right there, that curve right there that you're showing right there, Chris, that curve in the past would occur in precious metals all the time for seconds and minutes. So it would happen that, there's a shortage of physical demand, and that's in London and we're futures in the US. And so you had this little disconnect and there'd be opportunities, and that would be smacked down by the banks. They would keep that in line. But since the disaster in February 2020, that hasn't been the case. And this little EFP, it's called an EFP, exchange for physical, which is the first month in the US compared to the spot market, it's kind of sticky. And what Bob is going to, I think, explain very well is that when the market, I don't want to steal something, but when the market was dropping, the lower it went, the steeper the backwardation went in the front. So that implied that the physical demand was being taken in. They were buying it. They were buying the dip, and the funds were selling it. If you look at it this way, I'm taking delivery in London, and meanwhile, some speculative fund is selling futures in the US. So that situation right there you're looking at, that's usually temporary. What's weird this time, and not crazy, but weird, is that this is persisting. When the market rallies, it goes away. But when the market drops, it keeps coming back. It's come back over every gyration that we've had for the last 3 months. And historically, when that happens, it resolves itself with one of those full backwardation curves. And when that happens, that's the proverbial shit hitting the fan. And that's where people want their metal now, not tomorrow, and you have a full-blown short squeeze. I hope that's what you were looking for.